Welcome to another FAR walkthrough video. I'm Logan, and in today's video we're going to be going over adjusting the statement of financial position to correct errors. And we're going to be doing that the SuperFast CPA way, which is diving straight into questions to learn the material. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. We go over the key ingredients to passing the CPA exam, and again, it's only 1 hour, it is free, and we will show you how to pass the CPA exam without wasting any time. The link will be in the description, so make sure you go check that out. Also, just letting you know, we will only be going over 5 questions in this video, whereas SuperFast CPA members will have access to the full 10-question video when we post it in the members forum. So if you like this, you can get more of it by becoming a SuperFast CPA member. With all that said, let's dive straight into the questions. Alright, here we are at question 1, and just one more thing I want to say. If you haven't watched the previous video about preparing the statement of financial position, this video might not make as much sense. It might be a little bit more difficult because a lot of the knowledge that we gained in that video is going to carry over to this video, and it will be useful for us here. So if you don't know how to prepare a statement of financial position from the previous video, adjusting it for errors will be a lot more difficult. And this video is pretty straightforward once you've watched that previous video. This is kind of just a continuation of what you learned in the previous video, and you're just correcting errors this time instead of preparing it. So just giving you that heads up, let's dive into question 1. A not-for-profit entity is reviewing its statement of financial position and has identified potential errors in the classification of net assets. Which of the following items should not have been classified as without donor restrictions? Okay, so again, in the previous video, we've learned a lot about these different things, so now we're trying to look at this and see which one of these should not have been without donor restrictions. So there's a cash donation received with no stipulations. That sounds like it should have no donor restrictions. There was a grant received from a foundation with specific requirements. Okay, that sounds like it should have restrictions. Unrestricted investment. Again, that's unrestricted. Membership fees collected from members without any specific purpose. Okay, just by reading this, we can guess that it's probably B because all the other ones sound like they don't have restrictions, whereas this one sounds like it has a restriction, and we're trying to figure out which one should not have been classified in without donor restrictions. So let's go ahead and look at the answer to see if we're right. Okay, and we are right. The answer is B, a grant received from a foundation with specific requirements that the funds be used to support a scholarship program. Okay, let's read through this. The correct classification of net assets in a not-for-profit entity's statement of financial position depends on the presence or absence of donor-imposed restrictions. Net assets with donor restrictions are those that are subject to stipulations by the donor regarding how or when the resources can be used. So again, this is a lot of the stuff that we've talked about in the previous video. In this case, the grant received with specific requirements for its use should have been classified as with donor restrictions because the donor has imposed conditions on the funds. The other options obviously involve funds that don't have donor-imposed restrictions. So again, pretty straightforward. And that's what a lot of this video is going to be, because once you know how with and without donor restrictions works from the previous video, this video is kind of just making sure you understand it so that you know how to correct it when there is an error. So with that said, let's go to the next question. All right, here we are at question 2. A not-for-profit organization classified a $500,000 permanent endowment as with donor restrictions and $30,000 of earnings generated by the endowment as without donor restrictions on its statement of financial position. The earnings from the endowment are meant to be used for scholarships. What is the correct amount that should be classified as without donor restrictions? Okay, so again, we're talking about a permanent endowment here, and we're talking about the earnings from the endowment. They're supposed to be used specifically for scholarships, and they classified the principal as with donor restrictions and the earnings as without donor restrictions. So it's pretty easy to tell probably what the correct answer is. If it's not, go ahead and read through this one more time, and when you're ready, come back, we'll look at the answer together. All right, the answer is A, $0. Again, pretty straightforward. The $500,000 permanent endowment must be classified as with donor restrictions under the subcategory of permanent restrictions because the donor has stipulated that the principal has to be maintained in perpetuity. The $30,000 in earnings is also restricted by the donor because the earnings are meant to be used for scholarships, and therefore that should also be classified as with donor restrictions. Now, what they did is they put the $500,000 of principal in with donor restrictions correctly, but they did not put the $30,000 of earnings in with donor restrictions. They put it in without donor restrictions. So a pretty easy fix there. You just need to switch that $30,000 from without donor restrictions to with donor restrictions because, again, it's supposed to be used for scholarships specifically. All right, again, pretty easy to correct there. Let's go to the next question. All right, here we are at question 3. A not-for-profit organization received an unconditional promise to donate $100,000 over the next 3 years. The organization recorded the full amount as revenue without donor restrictions in the current year. What is the correct way to classify and recognize this donation on the statement of financial position? Okay, we've learned about this again in the previous video. Again, if you haven't watched the previous video, this video is going to be a bit more difficult, or if you just needed help with this specific topic, that's okay. But again, we talked about this before. So what happens when you have an unconditional promise? So the funds are not supposed to be used for anything specific, but you haven't received the money yet. How is that supposed to be recorded as time goes on? Think about it. I think you could probably figure it out by just reading these responses. So go ahead and pause the video, come back when you're ready, and we'll look at it together. All right, the answer is D. You have to recognize the full $100,000 as a receivable to start with donor restrictions, and then you reclassify it to without donor restrictions as the amounts are received over time. So, for example, in this case, the first year you would receive $33,333.33 technically, if you want to get exact, because over 3 years that would add up to $100,000. So that is the amount that would be moved from with donor restrictions to without donor restrictions once they received the money. But that's not part of this question. It's not saying that they've received any yet. So the way it works, an unconditional promise to donate is recognized as a receivable and revenue when the promise is made. So it is still a receivable. They're expecting to receive that. Since the donation is to be received over several years, the full $100,000 is initially recognized as with donor restrictions because, again, they haven't actually received the money yet, and so they can't use them. As each portion of the donation is received, it should then be reclassified from with donor restrictions to without donor restrictions. So that's where you reclassify it, is each year as you receive the money. The initial mistake is that they recorded it all as without donor restrictions because technically it is unconditional. They don't have to use it for something specific, but because they haven't received the money yet, they don't want to say that they can just spend $100,000 because they haven't actually received that money yet. So that's why you would have to correct this and only reclassify it from with to without donor restrictions as you receive the money. Let's go to the next question. All right, here we are at question 4. A not-for-profit organization received a promise of $200,000 contingent upon raising an additional $300,000 from other donors. The organization recorded the $200,000 as a receivable. What is the correct accounting treatment for this conditional promise? Okay, so right now all they've received is a promise. It does not say that they've received money. They've only received a promise of $200,000 if they raise another $300,000. So this is a contingent pledge, a contingent promise. They haven't actually received the money. By the way, you might see promise, pledge. The thing you need to focus on is whether they've received the money or not yet, and whether the contingency has been met. So think about this. They haven't received the money, and once they actually raise the other money, then they will receive the $200,000. But how would this be classified in the statement of financial position? Go ahead and think about it. Again, we've talked about something similar to this in the previous video, but if you want, go ahead and pause the video and come back when you're ready. We'll look at it together. All right, here is the answer. The answer is B. Do not record the $200,000 promise as either a receivable or a liability until the condition is substantially met. So this is where it can get a little bit confusing. You got to pay attention to whether cash has actually been received or not. A conditional promise should not be recorded as revenue or as a receivable until the condition on which it depends is substantially met. Since the $200,000 promise is contingent upon raising an additional $300,000 from other donors, it should not be recognized on the statement of financial position until the condition is met or substantially met. Again, we've just said that multiple times. The initial error of recording the promise without recognizing the condition fails to accurately reflect the organization's financial position and could mislead stakeholders. So basically, because they haven't received any money yet and they haven't met any contingency or they haven't met the condition, they don't record this at all. Now, on the flip side, if you had received the $200,000 and then there is that contingency of you can keep the $200,000 if you raise another $300,000, that's where you would record the $200,000 as a liability, because if you don't raise the other $300,000, that would mean that you would have to give that money back. But if no money has been given to you yet, it's just a promise, and you haven't met the condition yet, you don't record it as a receivable or a liability yet, because again, you haven't met the condition and you haven't received money. All right, that one is probably one of the more confusing things, but again, we've talked about it in the previous video. So this was just kind of a refresher on how that works and where somebody recorded it incorrectly. Now let's go to the next question. All right, here we are at question 5. A not-for-profit organization received a $150,000 donation that was classified as with donor restrictions because the donor required the funds to be used for a specific program. The program has now been completed. The organization believes it is classified correctly in the net assets with donor restrictions in its statement of financial position. What is the correct action the organization should take? So it was set aside for something specific. It had a donor restriction, But now the program has been completed. Should it stay in with donor restriction or should it move to without donor restriction? What happens? Again, if you've seen this before, then you probably know the answer. If not, go ahead and pause the video and think through this. Again, a lot of the errors kind of make sense once you think about with and without donor restrictions. Just think about what that means. Come back when you're ready and we'll look at it together. All right, the answer is B. Reclassify the $150,000 from with donor restrictions to without donor restrictions in the statement of financial position. So this is what you should do. When a not-for-profit organization receives funds with donor restrictions, those funds are initially classified as with donor restrictions. That makes sense. Once the specific purpose or time restriction is satisfied, the net assets should be reclassified from with donor restrictions to without donor restrictions in the statement of financial position. The failure to make this reclassification misstates the organization's net assets and does not accurately reflect the unrestricted resources available for general use. The correct action, again, is to reclassify it from with to without donor restrictions. And this makes sense. If money was set aside for something specific and then that specific thing was completed, now you can take that money that was set aside and restricted and move it to without restriction because now you can use that money for something else. So again, since the program was completed, they can move it from with to without donor restriction. And with that, we've learned a lot in just 5 questions, and mainly this was kind of a refresher on how this works because it built a lot off of the previous video, and we were kind of just correcting the errors based on what we learned from the previous video. So before we go any further, let's do one more part of the SuperFast CPA process called Pillar Topics. Now, the idea behind pillar topics is as you're going through the material, you will notice the things that keep popping up in the questions. These are the things that they're obviously trying to teach you. They keep trying to teach you the difference between with and without donor restrictions. They keep throwing questions at you about conditional promises or conditional pledges or things like that. These are the things that you keep seeing over and over again, and you write them down as pillar topics, kind of as a summary of what you learned, the most important things that you need to know so that you know them for later. Let's go ahead and look at the pillar topics for this video. All right, here are the pillar topics for this video, and they're very similar to the pillar topics for the previous video where we talked about preparing the statement of financial position because, again, once you know the pillar topics for how to prepare it, then you know how to correct it because you know what it should look like. So again, these are very similar pillar topics to the previous video. Net assets in a not-for-profit organization are classified as either with donor restrictions or without. Again, very clear and makes sense, depending on the presence of the donor-imposed conditions or stipulations. Permanent endowments must be classified as with donor restrictions under the subcategory of permanent restrictions as the principal is required to be maintained in perpetuity. So again, if you get a whole bunch of money and it's supposed to be maintained for investment purposes so that the earnings can be used for something specific, or even if the earnings don't have to be used for something specific, the permanent endowment itself has to be with donor restriction. Earnings generated from a permanent endowment, if not restricted by the donor, usually they are, but there are probably some instances where they're not, should be classified as with donor restriction. However, again, like it said, if not restricted by the donor, should be classified as without donor restriction. So let me elaborate on this one more time. The earnings from a permanent endowment, if they don't have donor restrictions, can be classified as without donor restrictions. However, frequently they are for a specific purpose, so they're classified as with donor restriction. Conditional pledges / promises, and again, you might see that different wording. The most important thing to focus on is whether they've actually received the cash. So conditional pledges or promises should not be recorded as receivables or revenue until the conditions are substantially met. Any cash received under such pledges should be recorded as a refundable advance, which is a liability. So again, if no money has been given, then this conditional promise or pledge, whatever it's called, should not be recorded. However, if you have received money but haven't met the condition, that's when you record it as a liability because until that condition is met, you may have to give the money back. Next, unconditional promises to donate should be recognized as receivables and revenue with donor restrictions when the promise is made, and reclassified to without donor restrictions as the funds are received and the restrictions are met. And finally, when the specific purpose or time restriction imposed by a donor is fulfilled, the net assets should be reclassified from with donor restrictions to without donor restrictions to accurately reflect the available resources. Okay, again, very similar pillar topics to the previous video. And with that, that is the end of this video. Before you go, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Again, it is only 1 hour, it's free, and we will show you how to pass the CPA exam without wasting months or even years of your time. We will show you how to be effective and efficient with your studying so you can still have a life. Also, remember that in this video, we only went over 5 questions, but Superfast CPA members will have access to the full 10-question videos when we post them in the members forum, so you can get more of this by becoming a Superfast CPA member. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.